All right, welcome everybody to our Monday Zoom and Learn. We hold these Zoom and Learns every Monday except for holidays, always at 12:30, always the same Zoom link. So we hope that if you get value out of it, you'll join us each week. My name is Tommy Dutcher. I'm the area sales manager with California Title, and I am only one portion of the help that helps put these Zoom and Learns on each week. My co-host, Mary Jane Morris with Granite Escrow. MJ, you want to introduce you and your team?
Hi, everybody. Happy to have you. I'm so excited for our guest today. I'm going to brag on her in just a minute, but let me just say hi to Tracy Hussey out of our Mission Valley office. How are you doing today, Tracy?
Hello, everybody. Great to be here. Excited to hear from Tiffany.
I'm so excited for the San Diego market. I know everybody, many people know her, but I'm so excited to introduce her to the San Diego market of our clients. We also have Jonna from our La Jolla office. Want to say hi, Miss Jonna?
Hi, everybody. And thank you, Tiffany, for being on today.
Oh, thanks
Great
for
to have you.
So as you guys know, we've tried to stay very close to the market. That's one of the things. We don't plan our classes much out further than about 4 weeks out. And we only did that because the rest of the team was would like to get ahead of my planning a little bit. So we start planning about 4 weeks out. We stay very close to what's really going on. I think the COVID forms dropped at about 8:15, and I think we were on at 8:30 the next day with them. So I'm so excited to introduce Tiffany Cross with Dedicated Repair. She is the owner and operator. She's going to tell you all the things it takes to be a credit repair person and how to choose one. But part of the reason we invited her here today, and I want to give a personal testimony, I moved to Temecula in 2010, trailing a divorce behind me with some advice from a shared divorce attorney. And I took that shared advice to Tiffany's team along with my credit report, and they absolutely turned all the advice up on its head. I did not have to do most of what was told to me. And one of those things was a bankruptcy, which I was anticipating having to do very soon thereafter. They absolutely turned my entire world around. Since then, every single person I've sent it to has come up significantly in their score, been able to buy. So we feel like she's ours because she's up here in Temecula and Marietta, Riverside area, but she is a national firm, and we do want you guys to have a chance to get to know her. Without further ado, Tiffany, I'll let you take it away and tell us about yourself and what you do. And certainly with the anticipation of the moratorium, which did not end as we anticipated and going into September, doesn't look like we're going to have much chance to do much cleanup before the holidays, and we're certainly going to be going into the new year. So I'm so happy to have you here today, Tiff.
well, thank you so much. It's always my heart to do this. I absolutely love building new relationships, and from that, we grow. We all do. And my goal is that we have lifelong partnerships together. So I think it's so hard to find people that like, and trust to work with. And so when you find that, it's always very valuable. And I like to reciprocate that, of course. So thanks again for having me. As Mary Jane mentioned, I am the CEO of Dedicated Credit Repair. We are located here in Marietta. We've been in business now 16 years. I don't feel like it could be 16 years, but it has been 16 years. I didn't even have kiddos back then, and now my youngest is 12. So anyhow, we are located here though in the Valley, but we honestly work with clients nationwide and have now for a long time. We are one of the few credit repair organizations that's actually registered with the Department of Justice. And I like to say that first and foremost when we get started, because unfortunately, when you hear credit repair, a lot of times people kind of, they don't, it's not a warm fuzzy. And our industry, like many industries, are kind of laden with the really good ones and then the really icky ones. And sadly, the icky ones are really the ones that we all have the nightmare stories about. So in order to be operating in California, most actual states, frankly, but especially California, you have to be registered with the Department of Justice. And that is like it's essentially like having your taxes intentionally audited every year by the IRS. Quite frankly, I think I would rather be audited by the IRS every year for my taxes. Don't tell me when I said that in case that happens, but we have to supply the Department of Justice with everything we do, from our application process to the procedures that we use, the way that we bill our clients, you name it, everything's scrutinized. So only 3% of companies out there actually are approved, and it's not a one-time fits all thing. It's literally every single year you have to go up for that renewal. So I see that to just let you know, this is not our first rodeo. We have been in business a long, long time, and we work specifically with people trying to buy homes. We have done that for so long that we really niched ourselves out to the fact that, I mean, I don't really get referrals from people that aren't realtors or lenders. It's just really what we do. I do no consumer direct marketing. We would rather have the relationship with our lender partners and real estate partners, I should say. And so that's really what we focus on, is doing such a great job that you don't just send one person to us. You end up sending, like I said, your lifelong database to us because you trust us and you know that we're going to do right by you and your client. So that's my long-winded introduction. I want to go through some FICO education. I do have a PowerPoint. Some of it I'm going to breeze over because I've done it so much that I think I can kind of summarize it sooner, but we do have some really relevant COVID credit type things I want to talk about. So before I jump in, I do want to say one more thing that I think I don't always do a great job of touching on, and that is that credit repair and debt settlement are not the same thing. And so unfortunately, when you ask, somebody, how do you fix your credit? They're going to say, go to Dave Ramsey or go to whatever. Debt settlement, debt management is literally night and day opposite of credit repair. We are simply the removal of negative items off of credit reports to increase FICO score. So we're not managing debt. We're not helping you negotiate debt. It's 100% basically plastic surgery on the FICO scores to get you able to buy a home in the quickest way possible and the most ethical way possible. So I just wanted to start by saying that, because no matter what, I always get that question at the end. I thought I'd maybe start with it this time. Okay, I'm going to share screen. Can you see my screen?
Not yet.
Okay, so that would be probably because I need to hit the word share screen. You think?
There you go.
How are we doing? Are we good now?
We're good.
Okay, so now I'm going to go up here to, I can get rid of that box off my top here. Okay. I can't get this little, there we go. Let's get that out of the way. There we go. Sorry, guys. You think I'd done this maybe once or twice. I'm getting stuck here. Okay, sorry, it was getting stuck. Got me? Can you see me?
Yes.
Okay, so I just went through my little introduction of who we are. We've been 16 years in business, but one of the things I also wanted to mention to you is that we really, really, really focus on tailoring our programs to the needs of our clients. So specifically that there is never a time that our information is ever duplicated. So every single person gets unique information. Okay, I want to talk a little bit about this because it's really relevant right now. When people talk about who are the 3 credit bureaus, we all know that TransUnion, Experian, and Equifax are the main 3, right? But what we don't always know as consumers is that they have literally nothing to do with the FICO score. Did you know that? Probably not. Mary Jane, you should know this by now. You've heard me a few times. But TransUnion, Experian, and Equifax do nothing for your score. And so when people go, well, I was at TransUnion or I went to Equifax and I got my report, you got to know that TransUnion, Experian, and Equifax are data furnishers. They're who all of the companies that you do business with pay to report data to, whether it be the length of history that you've had, your late payments, your positive payments. They furnish the data to the agencies. The agencies then supply their data to Fair Isaac Corporation, which is FICO. And FICO is who created the score that we all live and die by, okay? And so that's what the confusion is when people go to Credit Karma or any of these websites that are owned, by the way, by the 3 credit reporting agencies. They're not getting FICO scores. They're actually going to be getting Vantage scores or consumer generated, I call FICO scores. So you just want to be alert to the fact that if you're wanting to know your actual FICO score, you're going to have to go straight to the source, which is Fair Isaac Corporation, myfico.com, myfico.com. Okay, so that, a lot of people aren't aware of that. Now, when you go to FICO, you're going to get about 9 different scores, even from FICO. So there's your mortgage FICO, your auto FICO, your credit card FICO, you name it, lots of different versions. But the great thing about going to myfico.com is that it avoids a hard inquiry on your credit report. And you can see, gosh, I can see all of my FICO scores. You're going to pay for it, right? You're going to have to pay for it, but it's accurate and you don't have the hard inquiry. Now, jumping right into how credit scores are determined. When you look at the FICO score, it kind of changes every year a little bit on depending on what's going on in the economy, how much weight is applied to various topics. So one of the things I like to mention is that consumers, especially right now, are concerned. They're like, oh, I paid this off and my scores didn't go down or didn't go up and this and that happened. So keep in mind, the FICO score is designed in this pie chart format. Now, the FICO score is not in favor of you, the consumer. It wasn't created so that Tommy could look great on paper, okay? Mm-hmm. It's in favor of the credit card and lending institutions. So that's why the common sense things that we do as consumers often don't benefit our FICO score. It's very confusing. That perfect example, 35% of your FICO score is your payment history. Common sense would say it would be 90% of your score. I make good payment history, I should have excellent FICO scores, right? Well, 35%, the biggest component, does concern itself with your payment history, but it's not the whole thing. What we do know is that 1 30-day late, which is technically 31 days late, drops the FICO score currently about 60 to 80 FICO score points. Okay, so it's not a small issue when you have a 30-day late. This is especially common right now with people that think they're in a loan deferment, or perhaps they're in a forbearance situation and they're unfortunately not monitoring their credit until the very 11th hour, and suddenly there's a new 30-day late, and there are 2 or 3 of them actually, and they're down into the low 500s. So keep in mind, 1 30-day late will in fact drop your score 60 to 80 points. And you can rest assured that when it drops your scores, it's going to stay there for 7 years. Even if you bring the account current, that 30-day late will in fact stay on your credit report for the remaining part of 7 years. Okay, so just keep that in mind. The balances or whether the account is open or closed does not affect whether or not that 30-day late is impacting your scores. Now, 30% of your FICO score is your utilization of credit. A consumer will never have excellent credit if they don't carry a minimum of 3 to 5 credit cards. And FICO is actually saying as much as you can't just have them open, you have to use them fairly actively. So just having credit cards open with 0 balances in your wallet is not going to help you build 30% of your FICO score. It's very important as a consumer that you're not credit avoidant and you are in fact using your credit cards actively. Now, the sweet spot in the FICO score is that you don't want to exceed more than 25% utilization on any one card. When I first started dedicated credit repair 16 years ago, the utilization number was 50%. Then it dropped to 35%. Now the sweet spot is 25%. So if you have $1,000 credit limit, right? 200, 250 would be ideal as far as usage, and make those on-time payments. Quite frankly, it actually suits you better to make one on-time payment, perhaps a next month make another on-time payment, and the 3rd month pay it off in full. You don't have to be in debt to have good credit, but you have to show that you do utilize your credit frequently and that you know how to manage it effectively. So super, super important that when you're looking at obtaining credit, you look at it as a long-term decision. You don't want to go down to Kohl's during Christmas and open up a certain type of credit card just to save a certain percentage of money at the register. You want to go out and when you seek credit, obtain it wisely with the idea that you're going to keep it and use it for a long period of time. And the reason for that is that nowadays, even more in the last 12 to 24 months, FICO cares as much about the length of history as they do the fact that you use it frequently and with integrity. So again, opening frivolously types of credit for, at the register to save money, not so great. Definitely look at things that you already do business with. If you frequent Target and you like what they have to offer, great. Go to the places that you already frequent. Now, the rule of thumb is the APR and all of those types of things really shouldn't matter, because you should be able to pay in full the third month. Okay, so you're not really wanting to go in debt using your credit. You want to use it wisely. Credit mix is the diversification of credit. You guys, I can't say this enough. It is really important that you have a diverse credit profile. A lot of consumers are missing quite a few points because they don't have a diverse mixture of credit. Okay, and then the last section of this FICO score is inquiries, which we're going to talk about later. It is the one of the smallest sections of the FICO score, but certainly does have a consequence to your risk factors. Okay, we talked a little bit about who determines the FICO score. Obviously, when lenders are in charge of determining the factors of the FICO score, they're not really in favor of you, which is why installment debt is treated a little bit different than, than revolving lines of credit. So I just want to touch on this next slide just briefly. I kind of mentioned it quickly. Utilization of credit. Remember, it used to be 35%. Now it's 25%. And believe it or not, you're not going to get as big of an increase to pay it off as you would to pay it down. In fact, people that are making really aggressive payoffs on their current credit debt are seeing, just like we did in 2010, lots of credit card companies are starting to decrease credit limits to meet your balance. If you're a high credit risk, they're going, okay, something's going on, something funky's happening in Tiffany's world. We're going to decrease her credit limit to what she owes. And when they do that, it's now a maxed out credit card that's no longer with an excellent utilization ratio. If you have a 720-ish FICO and you're really wanting to see how can I get that FICO score up quickly and effectively, great way to do it is to call your existing credit card companies that you do business with and ask for credit line increases. Super effective way to get a quick and easy 40, 50 points by just simply asking the credit card companies that you already do business with to increase those limits. Okay, this is the big bad wolf right now, installment debt, okay? When you have an installment loan like a vehicle, solar, home improvement loans, a lot of lenders unfortunately use the word credit too often. The credit is like a catch-all for people that aren't in my industry and they don't really know what they're talking about, okay? Unfortunately, they'll say, fill out this credit application, which really should be called mortgage loan application, because a credit application doesn't care at all about what you make. They cannot discriminate and give you a lower FICO score because you only make minimum wage. There's a lot of people who make minimum wage who have 820 FICO scores. So in this case, when consumers are talking to their lender and they're asking, how much do you owe on your car? How much do you owe on this? And then they advise the client to pay off the car, or they tell them pay off an installment loan. The reasoning and rationale for that type of coaching is for your debt to income ratio, your DTI, which all of us know allows a consumer to buy a bigger home payment, right? So it is important to the loan application, but it absolutely thrashes your FICO score when you pay off a vehicle, when you pay off an installment loan. And the reason for that is because when I pay off my Chevy Tahoe, I don't have that credit line open anymore. It's paid off and closed, gone. So all of those 3 to 5 years of payments are no longer positively reporting, and a very solid trade line that was being used to calculate my score is no longer relevant to me, and it's gone. So it's very important to coach your buyer. Listen, if you're trying to increase your scores, then we don't want to be paying off installment debt. We want to be paying off revolving credit debt, which is your credit cards. Okay, now there is a time and a place to be paying off installment loans. Obviously, if the DTI requires it, that's fine. But just know strategically, it's not a smart thing to do from a FICO score perspective if in fact your FICO scores are a little bit vulnerable to qualifying. Okay, lack of credit. It's interesting because the very first thing that my clients will say, first of all, a lot of clients right now don't even have FICO scores. I don't know if you knew that. Super easy to completely lose your score altogether. So it's not uncommon for a consumer to come to me with a 40-page credit report and no score. Well, how can you have 40 pages of history and no score? Well, FICO won't give you a score if you have nothing positive to report. The whole thing can be negative, right? But if you don't have anything positive to report, you're off the radar completely, and a no score is worse than a bad score. Okay, so it's really important that we help clients establish credit, which is, by the way, part of our free consultation. There's good credit, there's bad credit, and that's really what we help our consumers really strategically plan for. By the way, if you don't have credit, obviously we can help the consumer do it, but secured cards are really the best way to start doing that if they can't be added as an authorized user to a spouse or to a family member, okay? Now, inquiries are really starting to pop up a little bit uniquely right now. The I guess conspiracy theory that I live with right now is that everybody's being told by their lender, you know what, I was told I could pull it 3 times as long as it's for a mortgage within a month, right? It's only going to affect my score once. Well, the truth is that if in fact the lender uses the same credit source to pull credit each time and it's the same lender, it's one credit inquiry, and that would be correct. Unfortunately, consumers shop interest rates, shop lenders all the time. The likelihood of that lender using the exact same credit pull source across the street at a different mortgage office is not very good. So what used to be 3 to 5 points, we're now seeing on average anywhere from 5 to 10 points from a hard inquiry. So again, now's more important than ever to be going to myfico.com, not a FICO score, a FICO score, to see exactly where you are so that you don't have to walk into a car dealership and have your credit run 75 times. You can go in and say, listen, I get the fact that you're probably going to need to run my credit, but we can talk financing with you knowing today that my auto FICO is 740. What are the interest rates available for me? I mean, they should already be able to do that for you based on a FICO score that's provided by you, especially with credit unions. They're real good at doing that and working with you. Okay, soft inquiries are anything like you going online and wanting to know what your scores are. Okay, so I know a lot of you out there are telling your clients, go to annualcreditreport.com. It's free. Stop doing that, please. The annual credit report is not the website you want to refer people to. Yes, it's owned by FICO, but there is no such thing as free. The report, the content is there, but the consumer still has to buy the score, which is ultimately what they want anyways. So it also creates all kinds of hardships when you go to dispute information. So again, myfico.com, consider it your credit Bible in your industry. In our industry, credit is foundational to any sort of transaction that you're going to try to do with your client. So without knowing where to go for the information, you're kind of in a pickle. So remember myfico.com. Okay, we already talked a little bit about the different varying scores. I will mention that if you go to a credit bureau for a report and you're not going to myfico.com, this is the first time I've ever seen it in my life where the Vantage score is often lower than the true FICO score. Used to be when you went to a FICO site like Credit Karma, usually that score was 40 to 50 points higher than a true FICO score. Through COVID, we have seen that change. And the reason for that is the Vantage score cares a lot more about the last 2 years, right? So we know everything's 7 years, right? But the Vantage score has a heavier weight on the most previous 2 years, whereas FICO cares about the most previous 4 years. So for some people, that's a good thing, that their hardship is more recent, and therefore, you know, the years previous are a little bit heavier in the importance. So just know there is such a thing as a FICO score. Go to the real site. I'm going to skip over this because this is a whole another hour of conversation. Collection accounts, friends, need to be carefully scrutinized on a credit report. There is a very unique way to settle and deal with collections based on the age, what we call the credit history seasoning. If it's outside of the statute of limitations, which in California is 4 years, then it has to be dealt with very different. That's something that's still within the time period where a consumer can be sued by the original creditor. So this is something where if you have a consumer or a client that your lender says they've got a page and a half of collections, they really need to be referred to an expert, because I can tell you right now, nothing pisses off a client more than taking part of their money that they were going to use on a down deposit on a home, paying off a bunch of collections and having it drop their scores. Okay. So you want to make sure that they're getting guidance by the experts and that they're not being, told the wrong things. Okay. Debt payoff strategies, things like that we just talked about briefly. Stay away from Dave Ramsey. I love him. I do a lot of things personally in my personal world, but he's not going to ever help your clients get excellent FICO scores. So you can utilize parts of what he teaches in the budgeting world, but certainly credit avoidance is literally FICO score suicide. Okay, so really important that we know that. Now, there are ways to add trade lines or credit lines to a consumer's report outside of authorized usership and secured cards. We have access to credit building accounts that we can help your clients obtain that they can add to their credit profile. It will report within 30 days and it'll immediately start building their FICO score. So if in fact we get the credit report and we see that they're missing 30% of their score, we have proprietary things that we offer your clients to help immediately build those scores up. So keep that in mind. Okay. Now, this is kind of, this has been why I need Botox way more often than I used to. When COVID happened, it literally rocked our entire industry. So the CFPB, which is the Consumer Financial Protection Bureau, jumped in during the CARES Act creation and essentially said to all three credit bureaus, listen, you're going to be overwhelmed, you're going to be understaffed, and we get it. So instead of having to abide by the 30-day window of responding to credit disputes, we're going to now allow you a reasonable amount of time, as long as you make a good faith effort. How well do you think that went over? Right? You basically gave them a long leash, which they ran with. And what ended up happening was the credit bureaus were receiving all kinds of credit disputes. People were frantic. People were putting things into deferment. They were then disputing things all across the board. And the credit bureaus were throwing everything in the trash, literally. And if you Google this, that you'll find it anywhere. So much so that the credit bureaus are under lawsuits by every Secretary of State in every state has a pending lawsuit against TransUnion, Experian, and Equifax for their gross, the way that they've handled the COVID CARES Act.
This is really a big deal, Jeff, especially with the avalanche of renters and bankruptcies and all that we're going to see as the moratorium kicks in.
Yes, it's been pretty crazy, you guys. So it was CFPB clarifies credit reporting procedures in light of coronavirus. So this came out April 1st, 2020. Okay. And what it was the Bureau said it will now allow lenders 45 days, right, to investigate credit disputes, increasing their duration by 15 days. Now, it's not bad enough to just add 15 days. They made it business days. Business days. So what used to take 30 calendar days is now 6 weeks minimum for a response by the credit bureaus. That's why when consumers are paying off credit card debt and then the lenders are doing rapid rescores and they're not wise, they've done research and they're like, well, I don't know why the scores haven't gone up. Nothing in the credit industry is overnight anymore. Not only is it that the CFPB came in and basically the government got involved in the private institutions of the credit bureaus, but the credit card companies don't have to immediately reflect payment balances. They don't have to do it. So some do, some don't. And instead of us doubling down on our sales team We doubled down on researching the changes because in my heart, we don't see them going back to the way it used to be. So we've had to create some major workarounds to make sure that our clients were still getting kick-ass credit repair. So that's why you're seeing the industry dwindling, and the ones that were always good are really, really good. And the ones that have just kind of always been talking about being good are no longer even in business. We've seen that a lot with some of the people that are being outsourced to by the new home builders. We'll get into that another time. So anyhow, lots of things have changed. This is why we tell clients, if you're even considering buying in the next 12 months, who cares when the moratorium's ending? You need to start now because it's not yet tomorrow night. It's not going to end. We got to get you going. And what used to be 3 to 4 months is now 6 to 8. And that's not because I'm slowing my process. It's because the government got involved in the credit industry. So I just wanted to touch on that because I feel like, you know, in fact, even today, I have probably 10, 15 people saying we're in escrow. What can you do? You need to not be in escrow. Your client needs 100 points. It's not going to happen. I don't, you know, so now that doesn't mean I don't want to be doom and gloom. We are still able to take someone up 100 points in 6 months, but it's just like joining a gym, friends. If you join a gym and you need to lose 60 pounds, you can't get mad at your trainer 3 weeks in if it's not done, right? You've got to give it the time for it to work. Okay. Now, we have new strategies of getting things deleted that the good news of all of this is instead of just using the Fair Credit Reporting Act, which has always been amazingly effective, still is, we're now able to use the Fair Debt Collections Practices Act. And the great thing about the CARES Act is it was so poorly written and created so quickly that it created a million different discrepancies with credit reporting. So we have so many more strategies than we ever used to have to help people legally, ethically, and permanently get things deleted from credit reports. Okay, so that's new and exciting. Okay, let's jump into some of this fun stuff. So I gotta move, okay, forbearance. I gotta figure out how to move you guys over this side. Okay. When you work with your mortgage servicer to temporarily pause your monthly mortgage payments, that's what a forbearance is. Servicers typically do this in response to a financial hardship, such as a loss of job. Okay. Almost always they're going to request documentation surrounding the income, assets, and expenses. This is a big deal because there are a lot of people in forbearance that got a new boat, that got a new RV, got sick of looking at their backyard and did a whatever. And they're thinking that when that time comes to forbearance, they're just going to be able to casually place the missed payments at the end of their loan. Okay. If you were the person that did not have a hardship, they're going to look into your bank. They're going to look at your finances. They're going to look at your purchases and they're going to say, sorry, no go. You can't, you know, say you were in forbearance, had a hardship when we see that you were working, you had a ton of different fun things that you bought and purchased. So we're going to start seeing that that's going to be on the forefront. That's going to be happening. Deferment is one of the possible options for repayment of past due amounts when in existing forbearance. So with a deferment, some of the past due payments are set aside to be paid at the end of the loan. Okay. Every loan servicer is saying something unique and different. Now, if it's a credit card, it's handled a little bit differently than a student loan, and a student loan is handled differently than a mortgage. So each of them are different. And frankly, things like student loans, some of them we weren't even asking to put in deferment or forbearance, and they just were. Some were just automatically, especially if it was certain types of federal student loans. So we are seeing all kinds of just different variations of what that's looking like. If in fact it was something that was put in place and you have documentation to support that it was supposed to be in forbearance, then and you do have 30-day lates that are popping up, 100% of the time we can get those deleted. And we aren't just doing that at the credit bureau level, we're doing it at the Consumer Financial Protection Bureau level. Okay. Okay. Repayment options after forbearance. Your options after forbearance may vary depending on what you qualify for, and your mortgage investor is the type, investor and the type of forbearance. So repayment plan is where you put part of your past due amount is added to your monthly mortgage. Okay, so we're seeing a lot of that where they are starting to now increase that payment. Now, if you are in fact underemployed or you have been affected with employment, that may no longer be affordable for you. And when those hardships start happening and we start seeing that there are new late payments being placed on the credit report, a lot of times that's where it goes into the modification loan, where you're actually able to modify the entire loan based on your ability to repay. Was it a true hardship, et cetera. So each lender is doing things differently. This also says, depending on your loan servicer's forbearance terms, you may have to pay more interest and additional fees as a result of paused payments. So you're not off the hook completely depending on what you have. Reinstatement, we know that this isn't an option for everybody, but if you are able, this is the fastest way to get your mortgage back on track and always recommended. I've been saying this from day one, there's no such thing as a free ride. If you're the person that, went into forbearance and is still in forbearance and your paychecks are even better than they were before, time to get off of forbearance, because I promise you it's not going to be pretty, especially as the world starts transitioning, as we are already seeing it, back into a typical flow. Okay, can forbearances or deferments hurt my credit? Okay, this is a big deal. How a forbearance affects your credit depends on your own situation, right? And the type of forbearance that you're approved for. The best thing to ask is, do you have me reported as 30-day late? And I'm going to say to you, if you come to me, what documentation do you have other than I talked to them on the phone? Because unfortunately, it's your word against theirs, like it is with everything credit related. And the real question is not whether deferment or forbearance is best for you, but which repayment options are available to you, because that's really what you want to know. You want to know, how do I get back on track the quickest way, and what repayment options are available? Is it going to be within my best interest to ask for it to be at the end of my loan? Or is it going to be something where they're going to increase my monthly payment? And if they increase my monthly payment and I can't afford it, best be talking to a realtor as soon as possible so that doesn't become a short sale. So, the writing's on the wall that this is either going to go really well for some and not so great for others is really kind of where we're looking at it. It is important to understand that forbearance is not loan forgiveness. Okay, this is not loan forgiveness. It's simply a postponement of your monthly payments, and you're going to be expected to eventually pay those missed payments. And there are several methods that loan servicers will use to collect those missed payments. Interest, and oh, by the way, fees. And that's where we're going to find, that they're going to play catch up on us. Okay. All right. So because of all these fun changes, the FICO score just said, oh boy, we got to come up with something. We got to get it out quick. Okay. The FICO score created a new, what we call resilience index. This is what my industry is buzzing about all over the place. In the past year, millions of people have lost their jobs and suffered financial hardships as a result of the economic shutdowns. Okay. We know this. Not surprisingly, the credit scores of millions of Americans have also plummeted. Not all, but some. And so in response to this, creditors have developed a new method of predicting how likely a person is to continue paying their bills as a result of an economic turndown. So they created the FICO Resilience Index. Okay, so this is above and beyond the FICO score. The score is 1 to 99, as opposed to the actual credit scores. A lower resilience index score is better than a high one. So that's what you're looking for, is how low can I get my resilience index score to be. The resilience scoring considers factors such as low balances on revolving credit, right? So we know that's part of the FICO score too. A lower number of open and active credit accounts. So again, this is what I've always said. I'd rather see my clients have 3 to 5, not 5 to 10. They don't want to see you have access to a ton of credit risk. 3 to 5 is the sweet spot. Now, fewer hard inquiries within the last 12 months. This is a big deal, because if you're out looking and buying a boat and you're doing all these things, inquiries show risk factor, right? So the more you are out applying, especially at the same time or all at once, the more damaging it is to your FICO score. So they want to see how many times you're running your credit in the last 12 months. Now, this is where I say to people, a longer credit age, which indicates more experience in managing credit. I've always said credit history is important. Now more than ever, it's important, especially your millennial buyers, to teach them, look at credit as a lifelong relationship. If you can have a credit card for 20 years, that is worth its weight in gold. And quite frankly, you can even add people to it and make money doing that. That's another conversation. But keep in mind, the length of history is now more important than ever, especially with this resilience index. Okay, here's how that breakdown looks. Okay, 1 to 44, more resilient to changes in economic conditions. 45 to 59, moderately resilient. 60 to 69, sensitive. 70 to 99, okay, very sensitive. Lenders are going to use this FICO Resilience Index in combination with the FICO scores and other information. They're already using it, okay? This is why I've not been a huge proponent of the Experian Boost, okay? Experian Boost was a very early on way for them to pilot the concept of consumers giving the credit bureaus access to your banking information. So basically, you've given them the green light to look at your checking account history. So if you're in loan deferment and you went on to Experian and wanted the free boost, and yay, I got 20 points. Uh-oh, now they know that you bought a boat and finished your backyard and you really kind of didn't need to have your loan in forbearance, right? So again, these are all the things they're using to calculate your risk factor. So it is very important that you stay the course. And again, do the right thing when nobody's looking, right? That's the definition of integrity. Okay, what a lot of people don't realize is your credit report doesn't show rental history, usually, right? We know that the only time your credit report is going to show rental history is if you broke a lease. If you broke a lease, then it's going to be a broken lease reflecting as an open collection, okay? So that's never been something that helped you build your scores until now. Now there is a way to report your rental history. In our company, we can help a consumer add 2 years of rental history. It will report within 30 days. And that will automatically start building what we call build the credit lines, build the utilization ratio. And it absolutely works. We do it all the time for our clients, and you can expect a quick 20, 30 point bump from just adding rental history that's in good standing. So we do that all the time. So for anybody working with property managers, this is like a Christmas present to you. This is what we can help them do. And it absolutely helps the FICO score, not necessarily all the FICO scores, but the true FICO score. So debit cards and utilities can also now appear on the credit report through the Experian Boost. But again, you kind of know my feeling on the Experian Boost. Last case scenario, worst case scenario. I don't love it for a lot of reasons. Okay, I'm going to give you a few of my little credit tips from Tiffany, and then we'll open it up for questions here. How cute is my little emoji? She's so cute. Okay, trying to keep you guys awake. All right. Always receive paper bills in the mail. I'm a huge fan of bringing my own straws and grocery bags to the grocery store. So I do my part with the environment. Don't do it with your bills, because the number one reason why people are getting 30-day lates right now on their credit is they're not seeing anything ever. They're not seeing it. They're on auto pay. They're not seeing their bills. What you're not seeing are the fees, the annual fees, all the different things that can pop up on a credit statement. When you're paperless, you don't see it. Frankly, if you don't see it, you can kind of forget about it too. So it's really important to get your bills every month. Touch it, feel it, see it. Never close credit cards. I don't like the word never, because you should never say never, right? But in most cases, don't close your credit cards. Pay them off, leave them open. So what if you've got an annual fee? If it's got 7 to 10 years of history, pay the darn fee. It is helping your credit to have it open, okay? Always pay your final payment of a car lease or a refinance on a home. Mortgage lenders will say, don't worry about the final payment of that. We're going to pay off that loan this month. And then you can skip your first payment because, so technically there should be a little window of time in a refinance where you don't have a payment. Don't listen, pay it anyways, because the likelihood of that going sideways and something happening and it not getting paid on time is really, really high. And I got to tell you, I have a lot of really, really well-known, well-respected lenders who have to then pay for their clients to be in credit repair because something funky happened at closing and the refinance, the original loan did not get paid on time. There's a new 30-day late and you have what should be a very happy client because everything went well during the transaction is now furious. So pay the last payment, let the company reimburse you. You will get reimbursed for that payment if it's an overpayment of the loan, okay? Never dispute items online. This, you guys, is why I have a business that thrives. When people go online and dispute items on their own and they click, 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 you're not requiring the credit bureaus to use the FCRA, the Fair Debt Collections Practices Act, the CARES Act stipulation. All you've done is ask them to match data. Matching data and proving data are two very different things. So that's why we're in business. Be hesitant to put a freeze on your credit, okay? This backfires so much, and I know everything that's going on right now, people hear about the dark web, you're hearing about all the scary things out there, and you're putting freezes because you're thinking, well, I already have my car, I already have my house, and I just want to freeze my credit. Don't. You literally are putting your social security number in prison, and what will happen is you will go pull your credit. It may work for you the first time, but it stimulates the freeze. And at that point, you're not able to do it again. And sometimes you have to get a notary. You have to do all kinds of things, fax 100 different times to Sunday, all 3 credit bureaus over and over and over to get it removed. And we often see that loans don't close and fund on time because the very last time that they were supposed to pull credit to fund the loan, it's frozen. And now they have to go through all kinds of hoops to get it unfrozen. And there's nothing we can do to help them. The better solution, just monitor your credit. Go to LifeLock, get a $15 a month. I call it my social security number insurance policy. Protect your social security number. They'll text you, email, call you when anyone runs your credit. And if they do run your credit, knowing right away, you can do something about it. So it's better to just monitor it than freeze it. Okay. Last thing, don't co-sign, first of all, but if you do, co-sign knowing you can pay the payment, right? So the better way of doing it is you pay it, you pay the loan, and have somebody else pay you back. Because there's nothing worse than putting the bill paying habits of someone that you know, like, and trust in charge of your credit. I have a ton of clients in my program because they co-signed for a family member. And because they co-signed, the family member didn't have the same concern for the debt. They moved, they didn't ask for the bills to be moved over, whatever the reason is. And now there are a 200-point loss on the person that co-signed. So have the person pay you back via Venmo or Zelle or something, but better to just put it in your name and be reimbursed. So therefore you can afford it. If you can't afford it, don't co-sign.
Well, that was wonderful.
Checking your credit. How often should I check my credit? Every single month. Okay. All right, guys, this is my information. I'm going to put up there, obviously dedicated credit repair. There's my information. We have a full team of people here at the office Monday through Friday, 9 to 5. Every time you refer a client to us, they get love. They get a complimentary roadmap with 30-minute roadmap, basically putting them on the right track. You as the affiliate referral partner get a copy of what the consultation notes consisted of. So there's always a full transparency involved where you know exactly what they were coached to do. And then to be completely transparent with you, I would prefer that you not just say my name and here's our phone number. If you take a few seconds to create an email, in fact, I already have a sample I can send you, an email template, Tiffany, meet my client, client, meet Tiffany, right? It takes the action step out of what's already a not very proactive client. And we take the initiative to warm them up to the idea of the free consultation. This is 1 out of 4 buyers. This is not people you don't want to work with or people you don't know. This is 1 in 4 people: divorce, illness, loss of job, catastrophic deaths, things like that of spouses. This is, unfortunately for you, 1 in 4 of the people that you'll come in contact with.
I think
So,
that besides the pleasure of introducing you and having everybody learn about the FICO score, because I literally cannot hear the word FICO without thinking of FICO anymore, because you've got me so trained. But with we did get a little push from the government that we're not going to have to expire until the moratorium until the end of next month, July. California's going all the way into September. I was wondering, and I really wanted you guys to have a way to help these people, because whether or, and her point about the 1 out of 4 buyers, I, as a broker, several times a year, somebody will sit in my chair and ask me how to make more money. And I would say, if you're not working the renter market, I don't still think to this day I've had somebody take me up on it. But the reason I wanted her here today is the renter market is going to explode with this eviction thing and the correction. And you are going to be able to build a wonderful farm, 100, 200, 500 of these people who need Tiffany's help. Tiffany, what are you anticipating the end of the moratorium is going to look like?
You know, we're already seeing it. I mean, at the end of the day, the end of the moratorium means that there's going to be a lot of people that are called to the carpet and they're not going to be able to afford their mortgage. So there will be, there'll be a lot of new listings. And I think what we're already seeing, at least the conversations that I'm seeing right now, are that credit challenged buyers stopped looking at homes. They just stopped. They don't have $100,000 over asking in cash to come in and pay. So what we're seeing now is that sellers are saying, I'm not going to sell for a penny less than what my neighbor just sold for 3 months ago. So they're not coming down on their prices. And a lot of my clients, again, credit challenge, are going, sorry, can't compete. I'm not even going to try, because I don't have it. If I did, and even if I did, I wouldn't do it. We are starting to see a little bit of a stall and a standoff. But it's also summertime, which is pretty typical, right? And then we've got the holidays coming up and nobody will even notice the holidays. So it'll be, in our world, my prediction is it's going to be January when we're going to start seeing some inventory hit in the market and the market shift. So if there is anyone, and renters are in a pickle right now because they're renting and they're being told you got 30 days to vacate. We're selling this, we're listing the house we want to sell. And even renters are struggling right now because they didn't act like when they should have, and they let their credit go. So this is a hardcore market, and it's going to be happening. We're already seeing it. So it's not if, we are actually seeing it now. We're usually about 6 months ahead of the market, the pulse on the market, because when we're looking at credit reports, we're seeing how the spending habits of thousands of people. And it's not just California. This is nationwide. So again, there's going to be some that listen to these types of meetings and go, wow, that was really great information, and they don't do anything with it. And then the ones that take a piece of it and run with it, they're going to be the ones that are in the 10% of the what's coming up.
I was really surprised. Many of you who, because all of us are realtors, most of us around here are in the real estate industry, obviously. I just think we're going to be seeing a lot of pain and suffering, and we're going to want to refer these people somewhere. I wanted to talk very super briefly, less than 20 seconds, about the interview process that you do. I took my credit report I didn't even get you that day. I got one of your excellent staff members. And before I left the office, without paying a penny, I had a plan. I had a thought. I knew what I was going to do next. And then your fees were outrageously reasonable. It is a small fee a month. You're not allowed to earn in advance, just like the realtors are not allowed to earn in advance. She has to earn it before she can. And I don't want to quote her and put her on the spot, but roughly $100 or less a month. For the experience of, and you can see the entire process on the website, as well as the realtors can see the process. So I don't know how many of you have noticed how many she graduates a month. It's 50 or 60 graduates a month of people who are now able to buy property who couldn't buy before. So I just felt this was a really good time to bring Tiff back. Like I said, we're lucky to have her, and we don't hesitate to dial. I'm sure other people have questions. Does anybody else have a question for her?
And just real quick, Mary Jane doesn't get any money to refer me. So this is not like a paid sponsorship.
I don't. I
Yeah.
really don't. I believe in this product. I do. Anybody else have a question for Tiff?
There was one in the chat, actually. Tiffany, are you able to just pull the chat up and I'll let you take it, or do you want me to read it to you?
If you could read it, that'd be great. I don't even see it.
David says, I'm talking to a credit consulting firm. Oops, hold on. Another one just came in and it moved. I'm talking to a credit consulting firm. You mentioned only having 1 to 5 number of credit cards. What's your opinion on 3rd and 4th tier cards like department stores? Do these cards hurt your credit? Also, if your main address is at an offsite mail house, UPS, others, etc., does that hurt?
That's actually a really good question. I haven't had that one in a long time. My first question back to him was, he's talking to a credit firm? I don't know what that means. Are you talking to a debt consolidation company? Who are you
It
talking
just says a credit consulting firm.
so that's what type of credit consulting firm is a huge part of my answer. But retail cards are absolutely a way to establish credit. They're not as user friendly because you have to use them frequently. Remember, credit card is a lifelong process of utilizing frequently. What you don't want to feel like is that you have to go down to the loft and buy 4 dresses a month to have good credit, right? So it's about using your credit how you would ordinarily use it, whether it be going to Target or the things that air miles, things that benefit you, with the idea that on the 3rd month, it's going to be paid off in full. So you don't want to get in debt. So retail cards are a way to get baby step in, not always the best. I really don't love them, but they do count towards diversification. The other thing is, as long as your PO boxes typically actually do create a higher risk. So it doesn't affect the scores per se, but when the credit bureaus have been sued many, many times, and in those, the lawsuit documentation, when somebody actually scrutinized some of the lawsuits that have come about, it's they're looking to see what kind of a transient lifestyle you have. So if you have 16 previous addresses, you're a higher risk of missing payments. So having a PO box or things like that have been proven to be a higher risk category. So not great. I don't know that it's necessarily going to, break the bank for you, but it is always better to have something that doesn't look or appear to be a PO box.
Okay. Another question in the comment from Daryl said, are second mortgages considered revolving debt?
Installment. They're installment lines.
So a second mortgage would be the same classification as like having a car payment.
Correct.
Yep.
I want to remind here in the pause that all of our classes are available in any of our territories, either by Zoom or by individual. We can talk to you yourself. We can talk to your team. We're happy to, like Tiff said, take over the burden of one of the things. Short sales are coming up, and we're getting ready to teach another short sale class. And one of the key points I teach is saving face. Most people who are credit challenged have done so involuntarily. The ones who are out spending their money like crazy and that sort of thing, that's not what I'm talking about. So people who have little kids and are losing their homes and that sort of thing, that's who we're going to be dealing with as we get into this market. So I'll remind you that it's Tiffany. I'm sure that you had that feeling from clients who are, I don't want to say ashamed, but are reluctant to reveal. And so they're going to be very particular about who they tell. And I think that's a good point about letting Tiffany take over, because her answers are going to be on point for their situation versus a pat on the head. But I want to remind you that the pat on the head is very important, and a guidance to where they should get help is going to be very important as we go through these next 12 months.
Absolutely. Yeah. And a lot of people, going through divorce and things like that, not everybody handled being locked in a house with their spouse for a year very well. So we are seeing a lot of divorce attorney referrals coming over. And of course, when that happens, the homes usually get sold and so forth. So that's the other thing we're seeing.
Well, we're over slightly, but I don't want to lose any questions. Tommy, do we have anything left?
So there was one from Brenda that said, when you check your score at each credit bureau direct site, is it accurate?
Only if you buy their FICO product. Most of them have a FICO product available for purchase. The free sites like Credit Karma, those no. But if you go directly to TransUnion, they do have to give you the option of buying the report from them. But if it were me, I'd rather spend the $40 to get the My FICO report, which gives me every version of the FICO score.
All right. She said, thank you.
You're welcome.
David had responded to his first question in regards to the credit consulting firm. He says, this is to build up personal credit to qualify for a business line of credit for experience with building up for a business credit.
So then the reason why I ask is because of that. Retail cards for business is probably one of the best ways to build your business credit. So the answer changes completely depending on, again, what I needed to know the context of that question. So yes, business credit, revolving lines of credit, store cards are great.
Just know that, and correct me if I'm wrong, but store cards, they always want to give you incentives to use their card, right? So if you don't have one, they're willing to give you percentages off, all that stuff. If all you do is get the card and use it that one time to save the 25% on your purchase or what have you, but then you never use it again, is it really helping you?
Exactly. So it just kind of depends. It just sort of depends on what you're trying to accomplish, of course. But at the end of the day, it's, find the things you think that will benefit you often and use them and keep them open.
Correct. Okay.
Oh, and yeah, Tracy, they do actually. There's websites that sell trade lines. So there's actually one right out of San Diego called Trade Line. I'm like, why is that not coming out right? TradelineSupply.com. And it's a company out of San Diego where people can actually say, gosh, I have a visa that I have had for 20 years and it has a $10,000 limit and I only owe $800 on it. People will pay you $800 to $1,000 to be added as an authorized user. That is still legal, but it is, if you use it and they find out that you defaulted on a loan, your mortgage lender, if in fact the mortgage lender was the one that told you to do it, you could be potentially pursued for loan fraud. So it's kind of, it isn't illegal to do. And when you go directly to the websites, they'll tell you it's legal, and it is legal. Yep. It's just not it's a gray area.
I've seen that work negatively as well. So be careful.
Yeah.
Where somebody comes in and they charge them $1,500 to pay their balance down to zero, and they add them as an authorized user, but don't give them the number to be able to use it or anything. And then a week later, the person that owns the card goes out and racks up, $6,000 on the credit card.
Yep.
Guys, be careful of what you're getting into as well. Know what you're getting into. It's a lot easier to try and work out something with somebody like and trust, maybe a family member, hopefully something like that, to add you as an authorized user without, even giving you the number to use or what have you, just to gain that credit and feel a little bit more comfortable that, somebody's not going to be able to go out there and affect your credit negatively as well.
Correct.
I did so little clothes shopping in that 12 months that I heard from Macy's and one other that said, come in and use it or we're going to take it away. What happens when the company closes you for non-use? Is that of a retail card?
I had the same thing happen to me, actually.
So did I.
Yeah. I didn't see a decrease in my score from that, which I was expecting to. So that's a great question. I have not had mine drop, and it happened to me. It's happened to a lot of my clients. But remember too, just because they close doesn't mean you don't owe them anymore. I have seen people stop. Oh, cool. They went out of business. No, they still have to pay. They're still taking money from you. So, yeah.
Yeah, no, I had a credit card that I had for like 5 years. Completely forgot about the card, really. Never used it. I think I used it like twice, didn't have a balance on it. And because of non-usage for X amount of years, the credit card company just closed it on their own.
Yeah. Yeah. And they do. So again, you got to use them. You can't leave them alone.
Yep.
Unfortunately, it's a bummer.
Seems like
How often do you have to use them?
Each lender is unique and different in that, but our best credit card practices, as all the experts will tell you on the FICO, on all the FICO simulations and everything that they tell you, is you want to use them every 6 months. So I like to I always tell my clients, don't carry debt. Make sure it's paid off on the 3rd month. I like to leave mine personally unused for a month or 2 and then use them again. And only use what you know you can pay off the following month, even though you shouldn't pay it off in full the following month. Keep one little.
So you should pay it off in 3 months, not pay all of your credit cards
Correct.
off every month.
Correct. Yes.
So I have a question for
But
you
still
now
keep
too.
them under the 30%,
Under 25%.
25%, and pay them off every 3 months. Okay.
Yes. And I would say, you don't have to go to 25%. That's the most you would want to use. So even if you just carried, a $500 balance and you made minimum payments a couple months and then following, you don't have to carry debt. I guess that's my whole point is, you can blend the 2 concepts together.
I have a question because I just got a text message from my credit monitoring, right? And it says your credit limit or your credit usage has increased significantly this month. Now, mind you, I do not carry a balance, so I pay everything off at the end of the month or when it's due, right, automatically. But on a particular card, we spent X amount of dollars, which was about 20% more than what we spent on it last month. Even though it wasn't a significant amount, I see that negatively affects as well. Meaning, let's say 1 month I only spent $200 on a card, I paid it off at the end of the month. The next month I spent $1,000 and I paid it off at the end of the month. But when the credit bureaus report it to the agencies, it's not in line with when your payments are due. It's
Right.
report it once a month, and how do you find out when they report your credit?
You call and ask them.
I've tried that.
They will tell you. Most of them will tell you when they report. They have to actually tell you. I don't know why they wouldn't have told you, but they have to tell you what date they report. Just like a collection company has to say when they report their collections every month.
So you're saying the credit card company has to tell you that?
They do. They have to tell you when.
Because I've called all of mine and not a single one of them would give me that.
That's crazy. That's part of your right as a consumer to ask them, and they have to tell you. And actually, Tommy, when we're offline, I can even send you for the Fair Debt Collections Practices Act where that's stated.
Okay.
So that's super important. But again, what's more important right now is that people realize that just because you paid it off today, don't even expect it to update in 30 days. The CARES Act changed that.
Mm-hmm.
So if you're going to refinance or you're going to purchase, it shouldn't matter what day they report, because you need to make sure it's paid down at least 60 days before you're going to apply for anything. Because the old days of rapid rescores to, oh, my client just paid this off, I'm going to rapid rescore it and off we go. Those are not as effective, especially right now. So while the CARES Act is in place, all bets are off and timeframes are not overnight.
Yeah, no, this isn't even carrying a balance. This is paying them off before they're even due.
Yeah. I was more talking to the general population of people that are trying to, because the advice I get from people is, when should I tell how soon should my clients expect their credit scores to increase after they pay something off? It doesn't even matter what day they report. It's 60 days.
Gotcha.
Yeah. And actually, this is something too, where if you have a mortgage lender that you partner with on a frequent basis, that you say, okay, Tracy says, well, I work with this lender, right? This particular lender. Your credit guru, meet myself, and your mortgage lender need to look at each file together, because the underwriting requirements from a mortgage are very different sometimes than the FICO coaching I'm going to give. And of course, because I've been in this industry for 16 years, I feel like very knowledgeable about what your lenders are going to tell your consumer. But it's really important, just like Tommy's question, well, this isn't how it worked for me. This is why you need 2 experts on every file. You need to be able to bounce things off each scenario, so that you're not just trusting Tiffany Cross, a dedicated credit repair. You can say, Tiffany told me this, my mortgage lender's telling me this, and then the 3 of us come up with a plan for you, so that you feel confident that your client's getting good, accurate information. And by the way, even that question, Tommy, I think that you just asked, is going to be easily located on myfico.com. There's literally a search tab where you can type in your questions, and almost all question answers are there.
Awesome.
I hate to romanticize it, but it does feel like magic to some of us, even those of us who've been around in the industry a long, long time. I definitely think this is a tool you should have in your belt. I think that we're going to have multiple opportunities to refer people to get good advice. The same reason that we are not allowed to give tax and legal advice is the same reason we can't give credit advice, essentially, which is every situation is just slightly different. And this plus that might not equal what you think it's, or something you haven't even thought of is an opportunity. So I really wanted you guys to have Tiffany as a tool in your belt. I know we just scratched the surface and we could go all day long. I know that everybody, and I think you should take the time to take your credit report, have your appointment, and take the time to experience this for yourself, because everybody will learn something.
And another plug for Tiffany and her group is their system that they've put in place to help your clients is extremely transparent. What I mean by that is they allow you as an agent to register on their site, and any agents that go through their program that are linked to you, you'll have direct sight to see where they're at in the process. And so will your lender. So, or their lender, I should say, which is awesome because, it stops the questions like, hey, where's this at or where's that at, right? You all have access to see it as a group. Not only that is, as she just alerted to, it allows you guys to work as a team with your client to help them.
Yeah.
Right.
Yeah. And also too, just so you know, all of my realtors that refer and lenders, once they're paired in my system with the person they referred, all of the credit tips that we email every week, everything that goes out, status updates, is co-branded. So it has your logo, your picture, your information with us next to it. So it very much keeps your face in front of your client. Well, I won't show you. I've got a whole box of stuff, but we send out, like I said, we're one of the only companies that spends the $30 a month that it costs to certify mail your disputes. Most companies don't. They just slap a stamp on it and hope it gets where it's going. So we can prove that too, like what days those go out. I did get a question regarding my price, right? It is $199 to sign up. That's your enrollment fee. Doesn't matter. I don't change it per person. It's $199 per person. And then the monthly fee, as Mary Jane mentioned, it has to be billed in arrears. So it's $99 a month. The average length of time in my program is 4 to 6 months. The average increase is 100 points. Some are much higher. I've got people on my Yelp just even yesterday who Yelped us 200, 300 points. I've got some that just sign up needing 15 points. So, I mean, everyone's unique and different. But you're never going to be in the program less than 60 days, especially now because of the credit bureau timeframes.
I personally am up 250 points from 2010 when I met you. And I did exactly what you told me. I made a couple of missteps along the way. I really like the retail cards a little bit, not too many of those, and started backing those off. But I know everyone can use you, and we're grateful to have you in this community.
Well, thank you everybody. I appreciate the opportunity. If you have additional questions and you'd like to schedule a personal consultation or one for your family, again, I can't stress enough how much we love working with you and partnering. We consider you our clients. So we absolutely treat your clients with, white gloves, because we want to make sure that we have a lifelong relationship. So thank you for having me.
Thank you, Tiffany. Guys, Tiffany's information there on the screen.
Thank you, Tiffany. Thank you, everyone.
This will be recorded, so it will be available for going back and rewatching. I did put in the chats the link to where all those are stored. And Tiffany, we greatly appreciate you taking the time to enlighten us today on everything related to credit and FICO. Hey, one last thing before we depart. MJ, next week, we are off with the holiday. We don't come back until the 12th with our Zoom and Learns the following week. And that will be with, correct me if I'm wrong, fast evictions, correct?
Yep.
Okay. We're going to be talking through forbearance. We're going to be talking through processes, things that are available to both landlords or tenants, et cetera, resources, everything that you need to know as we move towards the release of the CARES Act and stuff. So you won't want to miss that. Again, that'll be on the 12th, Monday, 12:30, same Zoom link. All right, everybody, thank you again for your time. We appreciate you all being with us. Hope you learned something. If you have any questions for Tiffany, you have her direct contact. Send her an email. I'm sure she will get back to you promptly. Thanks again for joining us.
Everybody. Thank you. Have a good week.
Thank you.
Thanks.
Thank you.
We'll have the recording out today, Tommy?